Hey Bowtie Nation, Joseph Hogue here, helping you to solve one of the biggest problems in monthly dividend stocks, that trade-off between high dividend yield and a stock price that goes nowhere. Investors rush into stocks like the San Juan Basin Royalty Trust, ticker SJT, and its eye-popping 8% dividend yield. That's more than 6 times the dividend you get from the broader stock market. But then this happens. Those shares of the high-yield dividend stock go nowhere and even fall as the market runs higher. Including the price return, investors in SJT earned just 5.4% a year over the last 5. That's less than a third the 17.8% annual return on the S&P 500. And I'm not just cherry-picking a dividend stock to prove that point. Of the 46 monthly dividend stocks I follow, 4 of them earned less than their dividend yield over the last 5 years. That means the stock price fell so much, it completely wiped out the dividend and then some. I found the total annual return on each dividend stock, including yield and price return. And you can see here, 4 stocks actually lost money, and 16 of them underperformed the return on the market. That high dividend stock trap is something 90% of dividend investors fall into, that trade-off between the yield and actual return. But the great news is, you can have both. You do not need to sacrifice stock returns to get those dividends. You can have both cash flow and price returns. In this video, I'll show you how to find the best monthly dividend stocks for both cash flow and return. I'll share 3 simple rules to protect you from that high yield trap, and then reveal the 5 monthly dividend stocks with the highest returns. Stick around though, and I'll show you 2 monthly dividend stocks that have struggled lately but could be your best investments next year. I'm excited to get to that list because these 5 monthly dividend stocks have averaged 124% return over the last 5 years, double your money plus pay you an average 7% dividend yield. We'll start with the list, and then I'll show you how I found these later, but first, you know we can't get started without that special shout out to all you out there in the nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. I'll be counting up to the stock with the highest return, and first on our list, Prospect Capital Corporation, ticker PSEC. Prospect is a business development corporation, a BDC founded in 2004 with over 16 years of dividends and performance. The company manages a $5.7 billion portfolio of 122 investments in companies across 39 industries and earns a 9.9% yield on its portfolio. Now that's more than enough to cover the stock's dividend yield and has helped it produce a 13.3% annual return over the last 5 years. Now BDCs make loans to small and mid-sized companies, those too big for your little regional banks but still too small to get money from the capital markets. And that portfolio yield that we talked about, that is the most important thing to watch for in these. You're going to find this in any BDC's financial statements, and it's going to be called the weighted average portfolio yield. It's the average interest rate the company makes on those loans. You want to make sure that this yield is above the dividend yield. So a portfolio yield above the dividend is not only a sign that the company can keep paying that dividend, but it's also making enough money that you're going to see that stock price grow as well. Prospect's portfolio yield is more than 2% above the stock's 8% dividend yield, so still saw a lot of room to increase that dividend and reinvest in the business. In fact, Prospect has returned a cumulative $18.60 a share in dividends for more than $3.3 billion since that 2004 IPO, and that payout just keeps climbing. That's the purpose of these BDCs, to act as a bank and investor to these mid-sized companies, manage those assets, and then return 90% of their earnings as cash flow to you as the investor. Next on our monthly dividends list is a fan favorite, Gladstone Investment Corporation, ticker GAIN, for a 5.5% yield and 113% total return. And now why I like GAIN here is because it takes a higher equity share than most other BDCs. Remember, those business development corporations are mostly making loans, so the upside is capped at that interest rate. But Gladstone's target investment is 25% equity and 75% debt versus a traditional BDC that might be able to look for a little less than 10% equity in the companies where it works with. That higher equity ownership might mean higher risk, but it's also going to mean higher returns on those investments. And we see that in GAIN's history of return on equity, which is well above the industry average. The 5-year ROE of 17% is over 3 times the median ROE for that BDC group, and even though near-term returns have come down, it's still well above the average for that group. Gladstone's current portfolio is spread across 28 companies in 14 industries, so a level of diversification that should help it continue those returns even in a sluggish economy. The shares have done so well, in fact, that it's been able to pay out multiple special dividends, boosting that cash return. We'll get back to that list of stocks, but I want to show you how to find these, and more importantly, how to find the dividend stocks that won't lose your money. Because nation, finding a list of monthly dividend stocks is easy. Any Google search is going to find you dozens of lists. Finding those monthly payers and the highest yielding ones, that's easy. But then it's the research and the analysis that's going to help you make those higher returns. That means looking at each individual stock to see which have produced positive price returns in the past, that higher stock price. To do that, you can go to Yahoo Finance and click on the Historical Data tab. And this is going to show you the stock price history and the dividends of any stock. Here you change the time frame to 5 years, and you can change the frequency to monthly. And you want to use this column on the adjusted price. That's the stock price adjusted for any splits and dividends. It's going to give you a true measure of that total return. So if we scroll down here, we can see that Apple was trading at $27.25 a share 5 years ago. And if we take today's price divided by that, we see the shares have produced a 5.5 times over the period, or a 450% return. And if you want to see how much that is per year here, you can just click this X to the Y button and then 0.2 for 5 years to see Apple has returned 40% annually over the last 5 years. And of course, the first thing to do is just make sure that total return is more than 1, or that the annual return is at least higher than the dividend yield. And that tells you that the company is producing a stock price return besides just the dividend. Next, you just also want to use some of that fundamental analysis that we talk about here on the channel, just to find those stocks that are going to produce that positive return. Remember, you're not just finding a good dividend stock, you're trying to find a good company and a great investment. This next monthly dividend stock, AGNC Investment, ticker AGNC, isn't as high as a return as the others, but still posted a 9% yield and a 50% return in 5 years. AGNC manages a $103 billion investment portfolio, with $99 billion of that in agency mortgage-backed securities. It's basically borrowing on those extremely short-term rates, leveraging that money up, and then investing in longer-term mortgages. Now that's how it's able to turn a spread of maybe just 2%, the difference between this borrowing and the investment payoff, into a 9 or a 10% return. Now besides that strong dividend yield, I wanted to include this one for a little bit of diversification. You're going to notice a lot of these high-yield dividend stocks are in just these business development corporations, so adding other types of companies like real estate stocks and the M-REITs is going to help protect your returns if something happens to that BDC industry. Now, book value is really the measure you want to use to value these mortgage REITs, and it hasn't been pretty for AGNC, now at $16.41 per share. And that means the shares are trading just under their book value, which is a pretty good place in terms of value. One bright spot is that the net interest spread, that's the difference between the interest rates on the investments minus those short-term rates on which the company borrows, that spread has increased over the last year, and the company is hedged on many of its products, so it should be able to continue that profitability ahead. Horizon Technology Finance, ticker HRZN, is a unique case in these BDCs, along with its 6.8% dividend yield and 130% return over the last 5 years. Horizon makes secured loans in the venture and private equity-backed companies in the life sciences and technology industries. And honestly, is there any better place to be investing in right now? That portfolio of loans is well diversified by sector, geography, and company stage. Now, all these are going to be those fast-growing startups backed by venture capital and again, a great niche in the healthcare and technology fields. So then here, besides that high yield you get from those typical business development corporations, here you're going to get a little bit of growth stocks as well. Now, the average yield on the portfolio debt is 16.3%, well above the 7% dividend yield. In fact, I think it's the biggest yield spread I've seen in a BDC stock. That keeps the dividend safe and is going to mean the stock price should continue to rise as well. Horizon has all the funding it needs near term, with a $45 million share offer earlier this year and a $100 million debt facility. Shares are paying the 9% dividend yield and paid a special dividend of 0.5% last April. And we've got 3 more dividend stocks left, but first I want to personally invite you to get the Weekly Bowtie, our free weekly newsletter with all the stock market news, trends, and strategies you need. That's absolutely free, just something I like to do for all you out there in the community, so look for the sign-up link in the video description below. Gladstone Capital, ticker GLAD, pays a 6.6% dividend yield and has rewarded investors with a 147% return over the last 5 years. And again, normally I would not load up a portfolio with so many business development corporations, instead trying to diversify it into more M-REITs, real estate stocks, and even MLPs, but this chart shows an interesting idea for the group. This is the average portfolio yield for Gladstone since 2012, and notice rates were much higher before 2019. Now, the average yield on loans was over 11.6% in the 5 years through 2019 versus just 10.5% this year. So what I'm thinking here for these BDCs is as interest rates rise over the next couple of years, you're going to see that average portfolio yield rise as well. As long as the economy just doesn't fall apart and loan defaults don't jump, these BDCs are primed to book higher cash flow and pay out those higher yields to investors. But again, just remember, if you are overexposing a portfolio to one type of company, especially these BDCs, then you want to pay special attention to each company's sources of capital and its business. For example, every BDC is going to show you the industries in which it loans out money and the types of loans it's making. You see here that Gladstone is well diversified across 17 industries, so a major event in any one group isn't going to materially affect the company. Now, before I reveal those last two dividend stocks, two stocks with an average yield over 6% and potentially the highest returns of the group, I want to show you the 3 rules to protect your portfolio from that high yield trap. 3 simple steps to make sure you book those positive returns along with your dividend cash flow. And rule number 1 here, just look at the stock chart. It's not a foolproof way of avoiding that yield trap, but it is a good start when the stock price has gone up in the past. You can calculate that actual return like we looked at earlier, or just look at the chart over the last 5 years. I wouldn't rule out a stock based on the chart alone, but if it doesn't check that next 2 rules, better just find another stock. Rule number 2 here, use relevant cash flow coverage measures, and this is something a lot of investors misunderstand. You see, the problem is a lot of these dividend stocks are in different types of company structures, and you're going to need to use different measures for dividend safety and cash flow. For example, for real estate stocks, these companies have very high depreciation taken off their income statement, so earnings are skewed and not really a good measure of actual cash flow. And that means you need to use a different measure, the funds from operations, or FFO, to compare how much cash is being generated and how much is going to pay that dividend. Now, for BDCs, we already talked about using that average portfolio yield to make sure that the company is earning a higher yield than it's paying out. And for regular types of companies, you can also use the payout ratio, which is just the annual dividend per share divided by the company's earnings per share. Now, this is going to show you how much of a company's profits go to paying that dividend. Too high, and it's not saving enough back for growth. And too low, and it's not much of a dividend stock. Now, this 3rd rule for creating your monthly dividend portfolio is to diversify into different types of dividend stocks. These different types of companies, from BDCs to REITs and MLPs, they all have different ways the economy and other factors affect the stocks. Now, higher interest rates might be great for BDCs, but not so much for MLPs or other stocks. Your first goal is to invest in good companies, but you also want to make sure that you're spreading your risk over different sectors and different types of companies. Now onto those 2 high dividend stocks that haven't blown the doors off returns lately, but could be about to jump higher. And our first is Pembina Pipeline, ticker PBA, with its 6.1% dividend yield. Pembina is a midstream oil company, which means it makes its money transporting oil and gas through pipelines, as well as gas processing and some marketing services. So overall, a very diversified business model in that energy space. And the company did have to put some projects on hold last year to protect cash flow, but it did maintain that BBB credit rating and has $2.5 billion in available liquidity. Now that the price of oil has rebounded, the company is a cash flow machine. The company has maintained its earnings growth through prior crises and has actually been able to make some opportunistic acquisitions like recent purchases of Kinder Morgan assets. Even after a strong run in energy stocks this year, next year could be just as good. The economic recovery should support the price of oil, and demand for pipeline transportation is going to mean good cash flows for this stock. Adding more diversification to the portfolio is LTC Properties, ticker LTC, and its 6.6% dividend yield. The real estate trust owns 180 properties in 27 states, with skilled nursing accounting for 56% of the revenue and assisted living centers bringing in the rest. Now, the shares are down 21% this year for obvious reasons related to the pandemic, but I was surprised researching this one that occupancy is still flat from last year at 85% in assisted living and 80% in its skilled nursing units. The company has been able to collect 92% of the rent due from property managers throughout the second quarter, so it doesn't look like the virus has affected the operations that much to the extent feared. But even if vacancies do tick up or the economic recovery stumbles, LTC has over $503 million in an available credit line and $50 million in balance sheet cash. The company has long-term debt of $689 million, but only $185 million of that is maturing through the next 2 years, so it's got all the liquidity it needs to make it through this. Long-term, this is a great play on America's aging population and the demand for senior living facility, and the stock is selling at a discount. That dividend yield of nearly 7% is safe, and I think you book another 5 or 10% a year in appreciation over the next decade. But of course, who wants to wait a whole month for their dividends? If you want your dividend checks every single week, click on the video to the right for a special portfolio, 12 dividend stocks for cash flow every week. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.